Hello and welcome. Let's take a look at our top story. Amid a raging war between Russia and the Ukraine, looming food and energy crisis on the horizon, and economies trying to recover from the pandemic gloom, global markets tanked on fears of recession. Even though the oil prices witnessed a sharp fall, the volatility continues to haunt the markets across the globe. Amid a raging war between Russia and Ukraine and all the economic problems following the recovery from the pandemic, and to the European Central Bank's pledge to bolster the indebted southern states, all of these factors have created turmoil in the markets that have been fluctuating for months now. Now, from battling with skyrocketing inflation, the fears are now focused on the looming threat of hitting recession and a slow rise in yields that surfaced amid the Federal Reserve unconditional commitment to fight the rising commodity prices. According to a survey, most top executives believe that a recession is looming or is already here. The survey by a Conference Board, which is a business research firm, surveyed over 700 CEOs and executives. The Wall Street's Dow Jones Industrial Average slipped 0.13%. The S&P 500 added 0.22%, and the Nasdaq Composite jumped 1.3%. For the week, the S&P 500 dropped 5.8%, also its biggest fall since the third week of 2020. In Asia, the MSCI's broadest index of Asia-Pacific shares outside of Japan fell to a 5-week low. The yen tanked after the Bank of Japan stuck to its ultra-accommodative policy stance for not announcing any swift spike in its interest rates. The yen fell 2.2%, bolstering the US dollar by over 0.5%. Japan's Nikkei fell 1.8% and headed for a weekly drop of almost 7%. Now, the Bank of Japan stuck to its strategy of pinning the 10-year yields near zero. Global markets are bearing the heat of the consecutive lockdowns due to the pandemic that affected the global supply chain and a waging war among the biggest grain and energy producers. Now, for more on this, we are being joined by Greg Swenson, who is a founding partner of the investment banking firm Brigg McAdam Limited. Thank you for being with us on this broadcast. Now, we are witnessing a high level of volatility in global markets due to a number of factors, but ultimately a fear of recession. Take us through the situation at the moment.
Well, that's a very good point you mentioned, Alison, the fear of recession. And in many ways, recession is already here. So I think the markets are definitely anticipating that. But you also have to think about the end of easy money, the end of quantitative easing from the Fed, the Bank of England, the ECB. The central banks have been really supporting financial assets for not just since the COVID crisis in March of 2020, but really effectively in the last 15 years, since 2009 and 10. And so by keeping interest rates artificially low and also buying securities in the open market, they've artificially supported the markets. That's come to a really dramatic end. So it's the combination of the two. And until the historical measures, for example, the U.S. values of equities typically trade at 1.5 times GDP. But with all the Fed stimulus and financial asset inflation, that went up to 2.5 times GDP. So until that comes back to the historical norm, I think you're facing some real headwinds in the liquid markets.
Absolutely. Now, markets globally, we've been seeing they've been hit by a series of events, the pandemic, supply chain issues that were brought about through that, now the war in Ukraine. What should the central banks be doing now to avoid this?
Well, it's a great question, Alison. They should be much more aggressive. And if you look at the Fed, it's arguably too little too late. They were asleep at the wheel for the last year. They should have seen this coming. They were wrong about inflation existing, and then they were wrong about, calling it transitory. So I think they need to increase interest rates a lot more aggressively. I think the market welcomed the 75 basis points earlier this week, but I don't think that's enough. I think they need to really be aggressive. And same with the Bank of England, who tightened, but only very incrementally at 25 basis points, and the ECB has not even tightened yet. Now they're indicating that they will, but I think all the central banks are late to the game. You mentioned Japan keeping with their accommodative stance. I think that's a mistake. So look, I think inflation is here to stay. It will get worse before it gets better. 9% in the UK, 8.6 in the US. Very low teens for the PPI numbers, the producer price index numbers. So inflation is here to stay. Consumer sentiment's at a 50-year low. That is making it a difficult choice for the Fed, because if they tighten too much, they're going to make the recession worse. But I think that horse has left the barn, that we already have a recession, and inflation is a much bigger problem.
Right. Greg, so I hear your opinion. Recession is already here in some of the largest economies. How is this going to affect the common man?
Well, it's going to be very difficult for the average wage earner, because inflation hits the working middle class much more aggressively than it does people who are have less elasticity to higher prices. It doesn't really affect them, but this is going to be very difficult for the poor and working class. With inflation, approaching 10%, fuel prices are dramatically higher, up 40% in the US versus last year. And you've got, energy prices in the UK for residential heating and energy, up well over 40% from just 6 months ago. So, I think it's going to be very difficult. It will cause some social unrest, especially in countries where there's going to be food shortages, which we can anticipate right now because of the high prices of food specifically, and made even more dramatic by the war in Ukraine, which, Russia and Ukraine supply 30% of the world's wheat. But that didn't start with the war in Ukraine. This has been going on for well over a year because of the overly accommodative central banks, but also the reckless spending by governments. Just adding 40% more dollars into the market is naturally going to cause inflation. It's a monetary phenomenon. So, this shouldn't have been a surprise to the Fed, but also to the governments, to the governments that were spending recklessly, even though the economies had recovered so well after the pandemic. That was, you saw, 30% growth in GDP growth in the third quarter of 2020 in the US, 6% in the fourth quarter, 4% in the fourth quarter, and 6% first quarter 21. Those are not conditions where you want to throw more money at the problem.
Right. Greg, thank you very much for joining us with your valuable insights and analysis there.
Great to be here. Thanks.
WION, now available in your country. Download the app now. Get all the news on the move.